Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst, and due to conflict in West Asia, a lot of correction has happened. Look at Indian stock market, look at US stock market, that also has shown some correction now. Look at gold and silver. Across the asset classes, there is a good level of correction. Now the question is that can we take advantage of this correction? Absolutely. In my view, absolutely. In fact, there are few assets which in my view are now at bottom. Reversal is likely to happen very soon. I'm recording this video on 1st of April around 8:30 a.m. when the market has not even opened. But my gut sense is that we are almost at the bottom, if not at the bottom. But I'm going to present to you a lot of data, and more importantly, let us say a hypothetical investment style of, let's say, 10 lakh rupees. Where would I go and deploy this 10 lakh rupees in these uncertain times? What are my risks? What are my reward ratios? Everything I'm going to present to you with data. A lot of data. If you're new to my channel, please hit the subscribe button because you're going to learn a lot. With that context, let's start with this hypothetical scenario of if I were to deploy 10 lakh rupees right now in the markets, how would I navigate through? How would I look at risk versus rewards? How would I look at various assets and say that, you know what, this makes a lot of sense? Again, not a recommendation here, but I'll give you a broad framework and some deep dive data points so that you get a good clarity about how these markets are spanning out. Let's get this video started. So the first asset I would look to invest, let's say around 55 to 60% of this 10 lakh rupees will be Indian stock market. Why am I saying that, and what are the risks I am taking if I were to deploy, let's say 55 to 60% of my money into Indian stock market? See, first of all, let's look at the valuations. If I talk about the data here, for example, if I show you Nifty 50 PE ratio, at the end of the March, it is around 19.6. Now have a look at the historical data last 5 years, okay? If you see the pink line, this is the Nifty 50 PE ratio, and what you note is the lowest it has gone to around 18.92. So we are very close to bottoming it out, right? If you look at the last 5 years average, right now we are at around 19.6 as I showed you. But more importantly, I show you another ratio because we have to look at it from a multiple, valuation parameters perspective. So what you need to look at is this chart here. What do you see is the Sensex to gold ratio. And if you go back to almost last, let's say 26 years, so going back to 1999 to 2026 here, what you note is that whenever Sensex to gold ratio has dropped to around 0.18, that is a extremely heavy support, okay, in terms of valuations. Go back to 2003, go back to 2009, go back to 2012, and fast forward to 2026, what you note is that we are at 0.18, extremely important parameter that has sustained over the last 26 years from a valuations perspective. And what is the top? Around 0.45, except one point when the market soared after the financial collapse. You can see that this ratio jumped to 0.60. That was exceptional situation, but more or less 0.45 has been the resistance if you look at the last few years, right? From this ratio perspective also, can I say that the markets are at bottom? Absolutely. In my view, Indian stock market has hit the bottom. Now tomorrow, if this war spans out and it becomes a World War III, I hope it doesn't. That is a different situation to again evaluate. But with the current ongoing conditions, looks to me that Indian market has made a bottom. 500 points here and there, you know what, that is normal volatility. I cannot say, why it has come down to 21,900 or 22,000, right? That I cannot say. But more or less, the bottom has been made from a valuations perspective. Okay, I've showed you two data points. Let me show you one more data point here, and this is also very interesting parallels that we need to understand. So if I take you back to COVID days, 13th March 2020, there is a data published here that around 1,006 stocks hit 52-week low. Okay, at that time. Now in March 2026, as of 23rd March, around 948 stocks hit 52-week low. Okay, I'm recording this video on 1st of April, right? I'm sure 948 figure would have gone very high. In the last 7 days, market have corrected even more, right? So my view is that we are seeing a good parallels between what happened in COVID versus what has happened now already, that more than 1,000 stocks almost are trading at 52-week low. And what happens when that happens? Markets almost bottom out, right? A lot of selling has happened already. So in my view, Indian stock market 55 to 60% allocation right now makes sense. Again, I'm not giving you a recommendation that you do that, but that is what my broad framework is. Having said this, there are a couple of risks that you need to be aware. Number one risk is FI's risk. So what you note is that around $12 billion of bloodbath has happened due to FI's selling, right? And let me put you this in perspective, what has happened. So if I go and show you the data here, yearly data for FI selling, what you note is the last 3 years, 2022, 2024, 2025. heavy selling by FI. So FI started exiting Indian stock market from 2022. In 2026, already a lot of selling has happened, right? Now, can this trend continue? It is entirely possible. This is the risk that FIs may not come back to Indian stock market sustainably. What I mean by is that there has to be heavy buying by FIs, which is not there in the last 3 to 4 years. Why Indian stock market have been resilient? Because of the DI's flow. Can you see the green charts here, green bars? Because of huge SIP flows, the markets have not crashed. Otherwise, we would have been in a difficult position, right? If I show you the monthly data, interesting data point, March, why I think this is another bottom that Indian markets have made. FI selling crossed around 1,22 crores. This is highest. Because if you go back to last 2-3 years, you wouldn't find this data point. October 2024, when the small cap started to melt, at that time, FI selling was highest, 1,14,000 crore. You can see on my screen that has been crossed in the month of March. So this remains a continuous risk for Indian stock market that FIs may continue to sell off, in pockets. It might slow down for a few weeks for now because the heavy selling has been done in March. Overall, this remains a risk in my view. The second risk that we need to be aware of is the GDP growth and the macro impact. So good article that CNBC published here, which was that the growth prospect of Indian GDP was around 7.4% before this war started as of March 2027 predictions. And government is acknowledging that this 7.4% is at a risk right now. So macro wise, there is definitely an impact. We cannot deny it. That risk remains, that we might see some slowdown. But you know what? Markets have already reacted to it. Okay, in the month of March, heavy correction in Indian stock market. Overall, I am very bullish on Indian stock market, more bullish than ever, right? Because of the reasons I've talked about from a valuations perspective. Now, Rahul, okay, all of this is understood. We got the context now. Where do we look to deploy this 55 to 60%? Now, this is where you and me may differ. Okay, my point is very simple. If I show you this data point that ICICI Direct beautifully put out, good credit, big credit to ICICI Direct team to do this analysis. Whenever there is a good analysis I see, I give them compliment. And if in fact you're liking this video, request you to do the same. Like this video, let me know in the comments, simple thank you for content creator, for analyst. When we get a simple thank you, it motivates us a lot. I can't tell you in words. Okay, so now have a look at this ICICI Direct's commentary. Sector wise, they have produced it. Okay, what they're saying is reality sector right now is under consolidation. Okay, from September 2024, since when the market started to correct, right? We are looking almost 18 months of period here. Reality sector, Nifty reality down by almost 41%. In my view, this is a good opportunity, good pocket. I'm going to show you some data points, but let me quickly go through these sectors. Infrastructure around 10% correction since September 2024. It's not from the peak. Okay, it's a consolidation phase is what ICICI Direct is naming it. IT sector 28% correction, but I am not very bullish on IT sector as of now. I don't think there is a good reversion very immediately, but we could differ here, right? Banks 5% correction, but from the top or from the peak, it is much more than 5%. 5% is from September 2024. Still presents a lot of opportunity in my view. Again, I'm going to show you some data points. Likewise, if you look at other sectors here, another one that I'll pick up is auto. 12% correction from September 2024. Very good consolidation, very good sector. Now let me give you 3 to 4 sectors where I think there is a good opportunity, huge opportunity, even if you play at ETF level or mutual fund level. Again, not a recommendation here, but let me show you some data point. Before that, I haven't talked about the small cap, mid cap or large cap. I'm very bullish right now, small cap sector. Why? I did a very detailed post here on my community just few days back where I talked about why I feel that small cap cycle is about to reverse in the next few weeks or so. Okay, I've gone through a lot of details, did this analysis for my community. If you're not yet a community member, consider subscribing. I share good analysis, deep analysis, as you can see on my screen, right? About small cap or any other market parameters. So here is the analysis. I'm very bullish. Out of this 55 to 60%, I would look at 40 to 50% deployment in small cap right away. It's likely to look good in the next 2 to 3 years in my view. Again, not a recommendation, but this is where my head is going. Now coming to sectoral view, the first sector that I'm extremely bullish right now is Bank Nifty. Okay, why do I say that? If you look at price to book ratio of Bank Nifty, it is right now as of 30th March around 1.7 price to book. Let us look at the historical valuation perspective here. Last 5 years, what you see is the green graph here, which is showing you the PB ratio of Bank Nifty last 5 years. And look at the valuations here. We are at the bottom here, which is around 1.71. It has never hit 1.71 if you go back to last 5 years of data points. Okay. Now, could it drop from 1.71 to let's say 1.6, 1.5? In short term, yes, absolutely possible. You cannot deny that. 1.71 can go down to 1.6, 1.5. That's the risk you take as an equity investor. But right now, if you look at the valuations, looks solid to me in Bank Nifty. Okay. The second sector that you can go and explore is real estate sector. Have a look at Nifty Reality. What's happening in Nifty Reality? The PE ratio is 30.8. You might find it slightly elevated. Okay, but let's have a look at some data in terms of the valuations. Pink line is showing you the PE ratio of Nifty Reality sector. And if you go back to July 2021, okay, since then, if you look at the data point here, which is almost 4-5 years of data point, PE ratio right now is at the bottom 30.80. Okay, the last it dropped to was somewhere here around 34.73 back in March 2023, right? One could argue that real estate sector has been in boom in the last few years post COVID, agreed, and it's a very cyclic sector, but right now the valuations looks very, very good. There is a potential that this might drop further, that you cannot deny, okay, because real estate sector is seeing some slowdown. There is no doubt about it. But would it be a bottom right now? I wouldn't say that it's a bottom, but from a valuation perspective, it looks attractive. It's not that it is gone crazy valuations, right? The third sector that you can go and explore is auto sector. Look at Nifty Auto. PE ratio is at around 28.1. And if I show you the last few years data points here, the green line that you see here, okay, this is the PE ratio. Back in January 2022 timeframe, the PE was huge, 64, 70, 90, 80. It then dropped to around here. If you look at this data point, April 2025, around 19.69. Okay. Auto sales were struggling, right? But after the GST boom or the GST cut that has happened in auto sector, the earnings have improved, the sales have improved, right? Of course, the valuations have gone higher, but it's now come down to almost at around 28. Good correction, okay? Because here it was gone to around 34 back in February 2026. Due to the war conflict, it has come down to almost around 28.10, and the structural tailwind for auto sector does exist as of now, right? It's a long-term sector. Of course, it comes with cyclicity. Right now, the valuations look very, very good to me. So this is another sector that I would go and explore and look at deploying around 55 to 60% of my money into Indian stock market. Now, you might have a different opinion in terms of the sector. And if you feel confident, there are a lot of good companies as well that you can go and do some research about. Here I've talked about mainly at sector level or ETF level or mutual fund level. Hope you found this analysis useful. With that, let me go to my second asset class that looks very, very interesting to me. The second asset class is gold. Around 8 to 10% of allocation definitely I would look to do in gold. Why? Have a look at gold's chart, and what do we see here? That gold has done a correction of around 13.44% when I'm recording this video. The bottom was somewhere here around 4,400. Okay. This is in dollars. Okay. Now, if I talk about this gold correction, why this correction happened? Couple of reasons. Number one, of course, when the oil prices went up, the fear of inflation kicked in. US dollar got really, really strong in the last few days, right? And when that happens, gold take a hit. And of course, profit booking also happened because gold had seen massive rallies. Okay, so that is very, very natural, this pullback. Second reason was that some of the central banks started to sell gold, right, due to Asia war. For example, Turkey, right? They looked at the data here and analyzed this and said that, they've been buying heavily, but due to Iran war, they started to sell. They sold some around 57 tons of the gold in the last few days, right? So some selling has happened by the central banks. But overall, if you ask me, what is the trend for gold? So I did this podcast with Motilal Oswal's executive director, Mr. Kishore Narne. Very, very interesting podcast. You must go and watch this podcast. There's a lot that he talked about the de-dollarization, which is a structural trend. It is not a short-term thing, and it might take, let's say, up to 2028, 2029, 2030 for gold to still continue to go further. Again, I'm not saying that this will happen, but during this journey, gold is likely to see dips like what we saw just now. Okay, fears will kick in, some profit booking will happen, some other macros will take an impact, and that's why gold will see these dips and things like that. And in fact, in my recent podcast with him, which was in Hindi, he talked about seeing gold taking a huge support at around 1,20,000. Again, it's his view, and why he took that view, he's explained that in a rational view. Also subscribe to my channel. There are 3 YouTube channels right now. One is Hindi channel, English channel, and third one is the podcast channel, right? Please go and subscribe to all the 3. You are going to get a good perspective, timely updates from the industry experts, and some data backed analysis. You're not going to find that content anywhere else. So request you to go and subscribe to all the 3 channels so that you get the notifications, right? So coming back to gold, structurally, I'm definitely bullish. But here is what I would say about gold. The volatility may be there, right? Therefore, look at SIP mode, because you cannot really look at gold from a price fluctuation perspective in terms of a lot of valuation parameters, etc. There is no PE ratio, there is no PB ratio for gold. There is a lot of volatility. Okay, SIP in my view works very, very good when you don't really see what's going to happen next because of no valuation parameters. Okay, so in gold, my SIPs remain intact. I started these SIPs back in December, continue to do that weekly SIP, have talked about that on my channel a lot. Again, not a recommendation, not a influence here, but I'm simply sharing with you what I'm seeing, in terms of the veterans saying stuff, and I'm simply sharing the data points that looks very, very interesting to me. That's on the gold. The third asset class is silver. Let me give you 1 to 2 minutes of commentary on silver as well. Now, when it comes to silver, around 5 to 8% of allocation does make sense, but again, you have to be really, really cautious and you need to be really okay with volatility. Here is what I would say about silver. Okay, I remember creating my first video on silver when silver was around $35. Okay. Silver bull run just got started, and that was a very, very good time. I talked about a lot of demand supply gap, etc. Okay, a lot of people said that, that was a good video at that time. When silver crossed almost 110 in 12, I started saying that, there's a lot of speculation in silver. This is a bad time in silver, and actually silver crashed from that time onwards. And at that time I said, you have to look at one important parameter, which is 200 days moving average. A lot of people in comments mocked me. They said silver is not coming to 200 days moving average. Guess what? It has almost got closer. Can you see here? 23rd of March 2026, it was almost about to touch 200 days moving average. So point is that do not mock anybody when they are showing you some data points. Of course, nobody knows the future. Everybody is trying to do some analysis and share with you. Agree or disagree is up to you, but at least don't mock anybody. That's what I would say. Now, coming back to silver, if I talk about what's happening right now, so let me present to you some data points. Here is some interesting data point for you about silver. There was some data collected from analysts, right? The consensus silver valuation came out to be around $81. Okay, where people said that, we agree silver valuation to be around $81. Okay, bearish case was around $44 and the bullish case was $309, right? Now, these data points are just predictions or forecasts. This does not really tell you the accurate future, right? But the consensus was around $81. But overall, if you look at silver from a positive drivers perspective, the structural growth of, industrial demand, it's still there. It's not that it has gone away. Okay. Yes, of course, there is a talk about replacing silver or doing little less coating or slightly thinner coatings on, let's say, solar panels, etc. But structurally, it still remains a good asset. Okay. However, the problem is the macro pressure, the strong dollar that we have seen in the last few days. Okay. And of course, the speculation. The biggest problem with silver is the speculation. Okay. If you look at the chart, when the silver crossed $80 or $90, that's where the speculation started to come in. Right now, one could argue that the speculation is limited, but silver remains a very, very volatile asset, not for everybody. And it's one of those assets where this is opportunistic behavior. You get in there, make some profit and quickly exit. It's not like you sit on it and wait for 20, 30 and etc. That is not the type of asset. So again, depending on your risk appetite, you will have to look at silver. If you don't like volatility, stay away from silver. That's what I would say, right? Let's go to now US stock market and let me give you some summary on that as well. Now, when it comes to US stock market, good correction has happened in US stock market, right? So therefore, there is an opportunity here. It really depends what type of investor you are, right? Whether you can select the specific stock in US stock market, whether you have that capability or the skills. And second is whether you want to trade at index level. That is up to you. That is your style. But definitely it makes sense to look at some allocation to US stock market. 18 to 20% wouldn't be a bad idea. Some correction has happened. Of course, there are a lot of risks with the US stock market. For example, Trump brings a lot of uncertainty. There is a question about AI theme, valuations, etc. Right? Those questions are still there. US has high debt. Those risks always remain with US, but market has been doing fantastically well in the last couple of years. If you look at US stock market, if you look at the last 3 months, a lot of companies have corrected. Index wise, also there is a good correction. For example, if you look at NDX, which is Nasdaq 100, last 3 months correction has been around 9.85%. Yesterday, it really rallied 3.43% on the news that Trump is saying that, we're going to exit this war, whether Iran really opens the Hormuz or not, irrespective, we're going to exit it. And on that news, 3.43% gain yesterday was seen in Nasdaq 100. But overall, if you look at 3 months, there is a lot of damage here already done. Look at companies like Google for 12.86% down, Microsoft 26.36% down. None of these are recommendations, by the way. You really need to know exactly which company is presenting you opportunity from a valuation perspective. Companies like Meta down by 19.46%, Nvidia is down by 11.93%. So really you have to look at whether you are bullish on AI theme or not, right? And if you are not sure about any of these companies, then look at, indexes like NDX or S&P or whatever makes sense, but there definitely a good chance of allocation here. Let me talk about NDX or Nasdaq 100 for a minute. Let me show you some data point here. If you look at this yellow line here, this is the moving day average, 200-day moving average. And here it has dropped below 200 days moving average when I'm recording this video. If you look at here back in, let's say April, May 2025, when the tariff news hit the world, that time also it dropped, but from that time onwards it recovered beautifully. If I come back here, go back to, let's say back in here in almost July 22 time period, it dropped below 200 days moving average and remained there for a few months. It's not that it immediately raised back up to some good levels, but history is telling us that 200-day moving average drop makes a good correction, makes a good case here. Okay, that is on NDX. If I talk about the valuations, for example, if I talk about the PE ratio of Nasdaq 100, it is seen some pullback around 33.61. Highest has been around 38.16. So it has seen some correction. But if you look at the mean, if you go back to last few years of data, mean is at around 24. So from that valuation perspective, it's still very, very high. So I've shared a lot of data points around US stock market here in a very, very quick 2 to 3 minute summary. Again, up to you what you want to do, but from an allocation perspective, one thing I would say, don't put all your eggs in one basket. Don't just go heavy on Indian stock market or US stock market or gold or silver. Look at the asset allocation. That is the basic principle of investing. That's what I would say. Also, the remaining money, I would leave it in liquid fund, let's say 8 to 10%, whatever remains, because you never know where the opportunities might come in the next few days or weeks. But in this video, I've tried to give you a summary. None of this is recommendation. Hopefully, the data point itself tells you a lot about where the markets might head to, right? And if you like that, request you to hit the like button. Let me know in the comments. Simple. Thank you. If you want to join my community on YouTube, most welcome. It's a premium content community. Exclusive content is what I try to post there. Let me know in the comments if you have any questions. Would love to answer that. Also, I'm going to see you in my next video. Until then, keep rocking.